Hi, my name's Amy and I work at EriksensGlobal and I'm here with my colleague Adam, and we've released our economic commentary for the month. And last month, looking back, we saw that the US put in tariffs that were at such a high level that we hadn't seen for almost a century, and markets really responded. This month we want to talk about how have those tariffs affected growth outlooks going forward for the next year. Do you want to expand on that, Adam?
Cheers, Amy. Yep, so I'm happy to talk about economic growth and what those tariffs mean. I think that a good place to start is to talk about what we've seen in terms of actual economic growth. So something that we saw come out early this month was the economic growth data from the US.
Yeah.
So that was an advanced estimate that showed us that the US economy contracted about 0.3% in the first quarter.
And why was that? Spoiler alert, import.
Yeah, it's overwhelmingly the import component. So the thing which is really interesting about that is the tariffs that we talked about last month, the tariffs that came into effect in April, those came into effect were announced on the 2nd. Now, this economic growth measure was just looking at the March quarter, but even the anticipation of tariffs was enough that the volume of imports overcame the increases we saw in investments and in consumer spending and resulted in a negative GDP print.
Yeah, and we know that didn't do anything to change the sentiment of the Federal Reserve because they unanimously still decided to keep the cash rate as it is. Now, going a bit locally, what we've seen in New Zealand has been slightly less exciting. We know that 20% of firms had a decline in trading in the last quarter, and also that almost 20% also are holding off on hiring new people. So here it's been pretty slow, pretty steady, and a little bit contracted. But what I will say is that in the RBNZ's inflation expectations survey, we saw that inflation expectations for 2 years from when the survey was released are at 2.06% on aggregate, which is, almost bang on the target of 2% inflation, so year on year. So that's kind of a positive uplift from little old New Zealand.
And it's certainly a better situation than what the US has. So last month in our economic commentary video, we talked a bit about transitory inflation. So that brief spike that the US Federal Reserve is expecting in US inflation as a result of those tariffs. And even though we've actually seen a really major deal reached between the US and China to put a pause on most of those tariffs for the next 90 days.
Another 90 days.
Speeches from the Fed have basically told us that we can't expect to see any real huge change to their actions as a result of it. And there's a couple of reasons for that. The first one is, while tariffs on China have come down from a high of 145% to 30%, that is still pretty massive, especially for a trading partner as big as China. And the second thing is the US labor market has actually held up surprisingly well through all of this. So 2 key data points that we've seen are unemployment and non-farm payrolls, basically measures of how many people are out of a job and how many new jobs are added to the US economy. And unemployment didn't change at all in April, and in fact more jobs were added than economists were expecting. So this essentially gives the US Fed the opportunity to sit back and say, hey, we've got room to see what happens with inflation without risking our maximum sustainable employment mandate.
Yeah, the employment numbers are really good news. All right, so if you want to learn more, you can subscribe to the economic commentary in the link below, and thanks for listening.
Cheers.